Welcome to This Explainer. Today, we're putting on our value investor hats and adopting that calm, highly analytical persona. We're currently looking at a market environment where some incredibly strong businesses are just getting their stock prices absolutely hammered. So we're going to explore exactly why holding your conviction and maybe even doubling down on some of those underperforming assets in your portfolio can actually be a brilliant strategic move, once you know what to look for.
It's the ultimate gut check, right? You open up your portfolio, and your top stocks have plunged by up to 40%. How are you supposed to react to that? Well, rather than giving into the emotional panic of a broad market sell-off, we really have to ask ourselves how a calculated investor finds the hidden opportunities in a sea of red. Basically, we don't panic, we analyze. Okay, let's jump right into the stark reality of this 2026 sell-off. We've got Tractor Supply down an eye-watering 40%. Meanwhile, Ulta Beauty and Veeva Systems are both sitting 23% in the red. Now, for a lot of people, this looks like a total disaster. But for a value investor, this just looks like a shopping list. Here's our roadmap for this explainer. We'll cover the 2026 sell-off opportunity, managing risk with small positions, Tractor Supply's pivot, Ulta's safety margin, Veeva's AI dominance, and finally, contrasting those margins of safety. Let's get into it. Section 1. The 2026 sell-off opportunity. Let's quickly establish the macro environment that created this pricing disconnect in the first place.
It's a weird market right now, isn't it? We're seeing this massive dichotomy. While global indexes have been hitting recurring highs this year, mostly fueled by that booming semiconductor run, where basically any stock with the letters A and I skyrockets, excellent companies in other sectors have just been unfairly punished. These persistent drags on portfolio performance are creating some very heavy market discounts. The market is entirely distracted right now, and that's tempting the calculated investor with generational discounts on truly fantastic compounding businesses.
Moving on to Section 2, managing risk with small positions. Let's look at how a core value investing philosophy protects us here.
Look, risk management is literally everything. When a stock drops 40%, it's terrifying. But if you maintain small, controlled allocations, it naturally caps your downside risk and completely insulates your broader portfolio from that severe volatility. Because you aren't over-leveraged, it buys you the psychological safety to patiently hold on to your conviction in these structurally sound businesses. And when they inevitably recover, they offer meaningful alpha through compounding earnings per share and multiple expansion.
All right, Section 3, Tractor Supply's strategic pivot. Let's run this one through our analytical gauntlet.
Talk about a massive gap between perception and reality. Wall Street absolutely freaked out over a sluggish Q1 for Tractor Supply. Revenue crept up just 3.6% and EPS declined 7.2%. Everyone panicked over unseasonable weather and macro caution. But what's the actual business reality here? Leadership firmly reaffirmed their full-year guidance. They didn't blink. They are already seeing that deferred spring volume bounce right back.
When we look closely at the actual guidance data they reaffirmed, they're still targeting 1 to 3% comparable store sales and an EPS of $2.13 to $2.23. This reaffirmed guidance is the proof we need that Tractor Supply is just taking a temporary pit stop. They aren't dropping out of the race, they're literally just waiting for the weather to warm up so their customers can start their outdoor seasonal projects.
And it's not just sitting around hoping the weather gets better either. To fix their core margins, particularly in the companion animal segment, they are actively executing these 3 brilliant catalysts. They're moving away from low-margin commercial pet food to build a high-margin health and wellness ecosystem. They're rolling out fresh pet refrigerators to 700 locations. They're integrating the Olivet digital prescription platform right into their 38 million member loyalty program. And get this, they acquired VIP Pet Care's 2,700 mobile vet locations. Think about that loop. A mobile vet writes a prescription, it funnels straight into the Olivet app for an automatic reorder, and the customer buys premium food while visiting the store. It's a phenomenal customer acquisition engine.
So, because of this massive market panic, you can currently scoop up this dominant retail compounder at a forward PE of roughly 13 to 14 times its reaffirmed fiscal 2026 earnings midpoint. If that spring volume flows through the registers like management expects, getting this unmatched rural lifestyle moat at 13 times earnings is just an incredible mispriced opportunity.
Let's pivot to Section 4, Ulta's built-in safety margin. We're going to see how their incredibly clean operational execution builds our thesis.
Again, we're seeing this wild disconnect. The stock is down 23% because the market is sweating macroeconomic uncertainty.
Yet Ulta's actual Q1 business reality showed comparable sales up 5.3%, a powerhouse EPS print up 15.5%, and gross margins expanding to 40.1%. I mean, they are executing flawlessly behind the scenes.
And this is a textbook example of management sandbagging their guidance. Despite that stellar Q1 we just talked about, management left their sales guidance completely untouched on June 2nd and only conservatively nudged their EPS target up to between $28.36 and $28.80. Why do that? Because they are establishing a very low floor as they prepare to lap exceptionally tough year-over-year comparisons from 2025. That baked-in margin of safety is exactly what we want to see. Honestly, that price correction, it was healthy. Because the market previously priced Ulta for absolute perfection, this sell-off brought it back down to earth. The stock is now trading at a highly reasonable 16 times forward earnings, which is a PEG ratio of just 1.2 based on management's conservative estimates. For a premium beauty compounder with expanding margins, that is a highly attractive entry point for sure.
Next up, Section 5, Veeva Systems AI Dominance. Let's see how they are navigating industry disruption.
So Veeva is also sitting 23% in the red. The bears are absolutely terrified of generative AI threats and rumors that they're losing legacy CRM customers to Salesforce. But check out the business reality. That bearish narrative is completely absent from Veeva's actual financials. They posted a clean beat and raise quarter. Total Q1 revenue grew 16% to nearly $883 million. And that CRM panic? Totally overblown. They just secured multi-year agreements with megacaps like Teva and boast an 80% migration win rate to their new Vault CRM.
When we look at the revenue segment trends, it totally proves that the legacy CRM noise in the commercial segment matters less and less every single year. The R&D solutions segment is rapidly outgrowing commercial solutions. In fact, by fiscal year 2026, R&D is projected to be 53.4% of their total revenue. The business is structurally shifting toward its higher growth areas.
And the kicker? AI isn't even a threat to Veeva. It's a catalyst. With their new agentic AI platform, Veeva Falcon, pharmaceutical giants are going to gladly pay them a premium to manage their AI infrastructure. Thanks to the broader enterprise software correction, you can grab this life sciences monopoly at a generational low multiple of roughly 19 times forward PE, or a PEG ratio of 1.4. Historically, this stock carried a perfection premium of 50 to 60 times earnings. Getting it at 19x is an absolute steal.
All right, final piece of the puzzle, Section 6, Contrasting Margins of Safety. Let's synthesize everything. Let's bring this whole explainer together. We've got 3 exceptional businesses, all trading at remarkably cheap valuations. Tractor Supply at 13 to 14 times earnings, basically just waiting on deferred spring volume over the next few quarters. Ulta at 16 times earnings, giving us a 1 to 2 quarter timeline as they clear those tough 2025 hurdles. And Veeva at 19 times earnings, offering a fantastic long-term AI infrastructure play. By adding to these as small, controlled positions, we cap our downside while positioning ourselves for substantial upside as these clear, calculated catalysts play out.
I want to leave you with this final thought from the source material, which I think just perfectly encapsulates the value investing mindset. Are you reacting to the immediate panic of the market's short-term time horizon, or are you adopting the calculated long-term perspective of the value investor, recognizing that structural strength and temporary mispricing create the ultimate opportunity for compounding wealth? Ultimately, the choice and the time horizon is entirely yours.